These are the go-to tax strategies we use with our clients every December to help them save thousands of dollars in taxes. I've narrowed it down to 9 actionable items. Let's see which ones could work for you. Let's dive in with managing your capital gains and losses. Now, managing your cap gains and losses before the year end can significantly reduce your tax bill. If you realized capital gains earlier this year, consider realizing capital losses by selling underperforming investments to offset those gains. This strategy, known as tax loss harvesting, reduces your taxable income and can help rebalance your portfolio. For example, if you made $10,000 in capital gains from the sale of property, then sell another at a $4,000 loss before the year end, your taxable gain drops to $6,000. This will save you a lot in taxes. Now, of course, I don't recommend you make this selling decision just based on this factor, but it's something to consider. Another strategy is if you're sitting on profitable investments, consider delaying selling those until January or later to defer taxes for another year. For example, selling a stock for a $15,000 gain in January of 2025 pushes your tax payment into 2026, giving you extra time to manage cash flow and keep more of your money to accumulate interest or investment returns. Now, these are very simplified examples, and the scenarios can get quite complex, especially if you have capital losses which can carry forward or backwards, or if your income varies a lot from year to year. Depending on the size of your assets, you'll also need to factor in the new capital gains inclusion rules of 66.7% over $250,000 in capital gains. Then there's also the consideration for retirees who are managing capital gains to avoid triggering OAS clawbacks and other recovery taxes. I'm not going to go too in-depth in that here. I go over it in way more detail in this other video. Capital gains and losses planning is an area where we spend a lot of time with our clients, particularly our business ones, so take the time to carefully figure this out. Next up is the tax-free savings account, or the TFSA. If you need to withdraw funds from your TFSA, it's important to do so before December 31st. Why? Because any amounts withdrawn from your TFSA this year will free up equivalent contribution room for the following year. However, if you wait until January, you'll have to wait another entire year to regain that room. For example, if you need $5,000 for an emergency or a large purchase, withdrawing it now ensures that you can recontribute that same $5,000 back next year. Delaying this could cost you valuable contribution space, limiting your ability to grow your investments tax-free. Now let's talk about the FHSA, which is my favorite new account in Canada. For existing FHSA account holders, remember that the FHSA contribution deadline is December 31st to get your tax deduction for this current year, not 60 days into the following year like an RSP. A lot of people get this mixed up, especially because it's such a new account. You can contribute up to $8,000 annually, and doing so by year end lets you claim a tax deduction for this year. That's instant savings when you file your taxes. The one exception to this is if you think your income will be much more in 2025 than in 2024, then it might be worth delaying it until next year if you are in a much higher marginal tax bracket. Here's an example. Suppose you earn $70,000 annually and you contribute $8,000 to your FHSA before December 31st. This reduces your taxable income to $62,000, which will save you a lot in taxes. Now, for those that haven't opened an FHSA, if you qualify but haven't opened one yet, make it a priority before December 31st. Why? Your contribution room only starts accumulating once the account is open. So starting now ensures you'll maximize your benefits next year. And here's a pro tip: even if you're unsure about buying a house, opening an FHSA is still a smart move. If it's unused, the account can eventually convert into an RSP, giving you more RSP contribution room. And a word of caution though, avoid withdrawing funds early unless you're purchasing a home. Early withdrawals can trigger penalties and the loss of tax benefits. Income splitting. For income splitting with a spouse or a common law partner, consider the following year-end actions. If you're doing spousal RRSP contributions, note that the contribution deadline for the 2024 tax year is not until March 3rd, 2025. However, note that there is a December 31st deadline if your spouse turns 71 this year, so be mindful of that. Some key considerations are the attribution rules. So if you withdraw from a spousal RSP within 3 years of contributing, it will be attributed income back to the contributor. CPP pension sharing. For the application timing, CPP pension sharing begins once Service Canada approves your application. It cannot be backdated. So to benefit in the upcoming year, submit your application this year using Form ISP 1002. Next, let's talk about the RESP and RDSP contributions and grants. Contributing to your RESP by December 31st ensures that your child receives up to $500 in Canada Education Savings Grants, known as the CESG, this year. The government matches 20% of contributions up to $2,500 annually per child. Missing the deadline means losing this year's grant, though unused grant room can be carried forward. For the RDSP, or the Registered Disability Savings Plan, contributing by December 31st can earn up to $3,500 in grants, known as the CDSG, and $1,000 in bonds, known as the CDSB, this year. Unused entitlements carry forward up to 10 years, but contributing now maximizes your annual benefits and makes sure that you get your grants quicker. For the RSP, if you turn 71 in 2024, December 31 is your final chance to contribute to your RSP before it must be converted into a RIF, not 60 days later. Don't miss this deadline, as it's your last opportunity to contribute to your RSP ever. For everyone else, it's worth noting that the RSP contribution deadline is March 3rd of 2025, so you still have some time to optimize your contributions. However, avoid early withdrawals from your RSP unless absolutely necessary, as the penalties can be significant. Medical expenses. As the year comes to a close, now is the perfect time to review your medical expenses. In Canada, you can claim a medical expense tax credit for eligible costs exceeding the lesser 3% of your net income, or $2,759 for the 2024 tax year. This means the more expenses you incur, the greater your potential savings. So for example, if your net income is $50,000, 3% of that is $1,500. Since $1,500 is less than the $2,759 threshold, you can only claim expenses that exceed that $1,500. So if you spend $4,000 on eligible medical expenses, you can claim the difference, $4,000 minus $1,500, or $2,500 on your tax return. So eligible expenses you can claim are prescription medications, dental work, vision care, and mobility aids. So here's a pro tip: if you're close to the threshold, consider scheduling additional treatments or purchasing necessary medical items before December 31st to maximize your claim. For example, getting dental work done or buying some medical equipment now could push your claimable expenses higher for this tax year. Charitable donations. Donating to registered charities by December 31st can reduce your tax bill through the Charitable Donation Tax Credit. The federal credit is 15% on the first $200 donated and 29% on amounts over $200, with additional provincial credits varying by region. You can see here that Alberta has a really high 60% donation tax credit on the first $200 donated. So for example, if you donate $100 in Alberta, you would receive the 15% federal tax credit plus the 60% provincial tax credit. So you would get a $75 tax credit on that $100. Some key tips here are the donation limit. You can claim donations up to 75% of your net income annually. There's also carry forward, where unused donations can be carried forward for up to 5 years. And then there's pooling, where spouses or partners can combine donations for maximum benefits. Maximizing employer benefits. While this is not directly tax related, this tip can still save you money before the year end. Many health benefits reset at the end of the year from your workplace. So if you have any unused allowances for dental, vision, or massage therapy, book those appointments now. Also, take any remaining vacation days that won't roll over to the next year. Don't leave money on the table this tax season. At Blueprint Financial, we create tailored strategies to help you reduce taxes and grow your wealth. Visit our website to learn more about our services and get started with our expert guidance. Please like this video, subscribe, and let's make your financial goals a reality.